Thanks for the intro, Rob, and thank you all for joining us today. Really appreciate you taking some time out. We have a lot of content here that I'm going to try to cover in the next 30 minutes or so, a little bit less, leave some time for QA. So I'm going to go ahead and jump right into it. I've got the presentation today broken up into three sections. We're going to start off talking about just our key indicators, where the market is at right now as we come out of the peak season. And then I want to talk a little bit about some potential shifts in the timing of seasonality in the market that we've been seeing over the past couple of years. And then finally, I want to just talk broadly about the macroeconomic picture beyond the rental market and beyond housing, and just talk about how that interacts with what we might expect to see in multifamily going forward. So let's get started here with our key indicators, and I'm going to start off, as I always do, with our rent growth numbers. This is showing month over month rent growth going back to 2019. So just in any given month, how much has the national median rent changed compared to the month prior? Our most recent data point for September saw rents falling by 0.4% compared to August. Rents also dipped slightly in August. So we've now seen two straight months of rents actually falling here. And that really indicates that we are kind of past the peak summer moving season and into the more sluggish kind of fall and winter period where fewer people are moving, and that tends to be associated with slight declines in rents. That's typical. This is the fact that rents are falling right now is not necessarily surprising. We see this even in kind of a year of more robust rent growth. It's typical to see rents dip a little bit toward the end of the year. So that in and of itself, maybe not too surprising. But with this month's decline, we are still seeing that rents are also down on a year-over-year basis. So compared to 1 year ago, the national median rent right now down just under 1%. And this is, indicative of this longer period of really sluggish conditions that we've seen in the market. We're now going back to mid 2023, so we've had just over 2 full years now where the national median rent has been falling on a year-over-year basis. And that really that is not necessarily typical. That going back pre-pandemic 2019 and prior, we were not seeing rents falling. We were seeing rents kind of increasing on more of that kind of 2-3% range, but now we've been on this sharp roller coaster where we had this really unprecedented spike, but now this prolonged cool down period. And when you add that all up, this is what the trend in the national median rent has looked like going all the way back to 2017. The dark purple line showing the actual trend, and the dotted line here showing just what would have happened if we had stayed on the trend that we had been from 2017 to 19. And you can see, if rents had just continued on that slow and steady 2 to 3% annual increase pace that we had been on pre-pandemic, right now we would still the median rent would be actually still a bit lower than where it has ended up in actuality, even with this prolonged cool down, just because that spike in 2021 and the first half of 2022 was so sharp. We're now down about 3% in total from that peak, but rents are still more than 20% higher than they were at the start of 2021, and about 3 to 4% higher than where they would be if they had just remained on that pre-pandemic trend. So despite that sluggishness, that has not fully offset that prior period of really, really strong rent growth. And I think that's always an important thing to keep in mind, when we talk about how soft the market has been. Part of that is just that I think there was some room for the pendulum to swing back a little bit after this period where we really had seen a little bit of overheating, perhaps. Now, of course, the regional trends here show a lot of variation. So that 1% roughly decline that we've seen nationally, there's a wide spectrum that we see when we look at this on a market by market basis. Most of the markets that are seeing the sharpest declines right now are in the southern part of the US, the Sun Belt, and meanwhile, a lot of the Northeast and many of the West Coast markets are maintaining positive rent growth. A lot of this is correlated with just where construction activity has been fastest. That is really kind of the story of of what's driving a lot of this softness over the past couple of years, is that we've just had a really big wave of new supply. Austin, Texas, the market that far and away has been building the most new multifamily housing. And that's really kind of taken a toll on rent prices there. The median rent in the Austin metro down 6.5% over the past year and down 18% from its 2022 peak. Uh, Denver, Phoenix, Tucson, we're seeing a lot of these markets in that region of the country. Also markets that have kind of built a lot that are also seeing rents decline. None kind of at the scale of what we're seeing in Austin. A lot of the markets in Florida too, even though they don't crack kind of the top five that I have listed here, have seen prices dip over the past year. Meanwhile, some of the markets that actually had seen prices falling earlier in the pandemic are now seeing a stronger rebound. San Francisco, the Bay Area, is kind of the foremost example there. We've got both San Francisco and neighboring San Jose in the top five for year-over-year rent growth right now. And so I think, it's important to keep in mind that when we talk about this national trend of pricing being pretty soft, it's really important to just keep an eye on what is happening in your particular market, because that national trend always masking a ton of regional variation. And so flipping to the supply side of the market, that softness that we're seeing, we're not just seeing that in pricing, we're also seeing that in occupancy. Here I'm showing the national multifamily vacancy rate of the properties that we observe in our marketplace. This is limited, I'll say, to just to stabilized properties. And so, when we see this vacancy rate kind of increasing in recent years, it isn't the case that we're just adding a bunch of these new lease up properties into the sample. We're actually holding those properties out until they reach stabilization. So the increase that we're seeing here is actually really that secondary fact, that because there is all of this new competition from all these new lease ups entering the market, properties that had already been stabilized are seeing their occupancy soften. Right now, the national multifamily vacancy rate at 7.1%. That's as high as we've ever seen in our index, which goes back to the start of 2017. So, over a decent period there, we have never seen the vacancy rate this high. And it actually is continuing to increase right now, very gradually. It's maybe leveled off a little bit. But even as the supply wave, as I mentioned, that is kind of the key factor that's been driving a lot of these softer conditions, is just having a ton of two new units hit the market. Even as that has kind of gone past its peak, we are still seeing the vacancy rate increase. And then the other indicator that I want to show here is our list to lease time. So how much time does it take for units to get leased after they are initially listed in our marketplace? Right now, that's at 31 days. That's been increasing over the past couple of months as, again, we've kind of started to shift from peak season into the off season. It's lower than kind of the beginning of the year, which was an all-time high. But this is higher than what we typically see in September. So for this time of year, the units are sitting a little bit longer than they typically do. Okay, so now I want to shift gears and talk in a little bit more detail just about the seasonal timing of some of these trends that we're seeing in the market. As I'm kind of talking through these rent trends, you'll hear me say a lot of things about, this is typical for this time of year, and that's because we see a really sharp seasonal trend in the market. There's a clear period where there are more renters moving, which is associated with tightening occupancy and more pricing leverage. And then there's a clear kind of off season when fewer folks are moving, when pricing and occupancy tend to be a bit softer. But what we've seen in recent years is that there might be a little bit of a shift in some of that timing. So here I'm kind of showing kind of two periods averaged over a couple of years. So This is month over month rent growth. The blue bar showing pre-pandemic trend averaging over 2017 to 2019, and the purple bar showing more recent trends 2023 to 2025. I'm excluding 2020 to 2022 just because those were these really kind of abnormal roller coaster pandemic years. But over these past couple of years, it feels like, even though rent growth has maybe been kind of not in that sort of steady 2-3% range, the market is still kind of a lot more stabilized than it had been in 2021, 2022, 2020. And so I think 2023 to 2025 presents a good comparison. And what I want to call out here is just the timing of when we're seeing the peak rent growth. In 2017 to 2019, really all of the pre-pandemic years, there was a pretty clear trend where from the start of the year through kind of mid-spring, early summer, we would see rent growth gradually accelerating as we ramp up into the peak season, peaking in May, June kind of remaining quite high. And then as we get into the kind of back end of the moving season, starting to taper off, then through the fall and into the winter, we see these kind of modest declines. But now what we've seen over these past couple of years is rent growth is peaking a couple of months earlier. It's actually peaking in March and then flattening off, and that drop off into the off season also is starting a bit earlier. So we're seeing in August of these past couple of years, rent growth flipping negative, and then seeing progressively sharper declines through the remainder of the year. And that's actually something that we see mirrored in statistics that we observe in the renter behavior of folks looking to move on our platform. So here I'm showing data on a handful of key milestones in the renter search journey that we observe on our platform. Again, kind of broken out through these two periods, that pre-pandemic benchmark and then the more recent years. And I'm showing three kind of key points here. Registration date, preferred move-in date. So that's when folks register the date that they're telling us that they're looking to move in, not necessarily the date that they actually do move in. And then finally, the date that a user actually signs a lease. And you can see shifts in all of these, right? In the registration date, Q1 is actually where we see the highest share of users registering, of all the users that register in a given year. Nearly 30% of them are registering in Q1. Now, you expect registration date to be kind of a little bit shifted from that peak moving season because it is a leading indicator, right? That folks have to register and get their search started before they sign a lease. But previously, we would see kind of Q2 as the peak period for registrations. Now that's shifted forward into Q1. And then similarly, when we look at preferred move-in date, previously we were seeing this really clear peak in Q3 being the highest share of users looking to move in. Now that's actually pretty evenly distributed from Q1 to Q3. We do still see that decently sharp drop off in Q4. I think the kind of timing of folks not wanting to move around the holidays, that still holds, but that sharp kind of summer moving season, it's really not playing out as starkly as we had seen in the past. And similarly, even when we look at lease date, which is kind of obviously the most concrete indicator here, you do see when you look at Q3 in 2017 to 2019, that big spike there that has now kind of evened out, where Q2 and Q3 in more recent years are having a pretty equal lease share, and we've seen a big rise in the share of leases being signed in Q1. So this is pretty interesting shift that we've seen over these past couple of years. I think there's a few factors potentially at play here. One is that I think we're just seeing kind of an ongoing legacy of the pandemic here, right? If you go back to 2020, there was a one-time shock where in March of 2020, we had a once in a lifetime event that caused folks to maybe kind of move at a different time than they would have otherwise. And then because folks still, the vast majority of leases are 12-month leases, you kind of shift the timing of your move one time, and now that progresses through on a 12-month lease, and you see the echoes of that kind of move forward. I think there's also we've heard anecdotally that some properties actually prefer to even out kind of the distribution of leases throughout the year as opposed to having kind of one really big peak season in the summer. And so, some of this is maybe by design too, that we're seeing this more even distribution of lease dates and factoring through to rent growth. But the final thing I want to say about this is that it actually is not necessarily uh, evenly observed across the board geographically. We're seeing this play out more sharply in some regions than others. So this is mirroring that first chart that I was showing again with the monthly rent growth numbers, just broken out here now by region. And so the West Coast, we see that really sharp shift where that peak rent growth month has shifted forward to March. Similarly, in the Sun Belt, same thing. But then the other regions kind of a little bit less so. In the Northeast, it's still the case that May is the peak rent growth month, although that has kind of evened out a little bit where, that ramp up period is not quite as sharp. We're seeing pretty even rent growth from March through May, indicative of this kind of shift forward in the seasonality. Midwest looking kind of more typical to what we had seen pre-pandemic, so less of a shift there. And then similarly in the Mountain West, where here you see kind of just a lot more starkly really divergent rent trends, where rents were growing much more quickly pre-pandemic. This shows up really starkly here in this chart. But if you just look at kind of the trend of when the peak is, fairly similar. So maybe this is something that is not necessarily playing out everywhere, but I think a really interesting shift in renter behavior that we're starting to see here, and that I think could continue going forward. Okay, and then in the last few minutes here before we turn it over to Q&A, I wanted to talk just a little bit more about some of the broader macroeconomic trends that are dictating what we're seeing in the market right now. If you're following the headlines, I think it's really still a lot of whiplash that we're seeing in terms of, some of the policies that are being enacted by the administration as far as tariffs. We're hearing a lot about the labor market looking a little bit weaker than it had been previously, and some of that kind of just broader macro outlook potentially dampening a little bit. And so I want to talk a little bit about that because I think this is part of the reason why we've seen rent growth remain sluggish. I think starting this year, what we were expecting to see was, we're coming off of this really big wave of new units hitting the market. There's still a pretty healthy and robust level of new supply hitting the market, but it has come down from last year's peak. So we were expecting, okay, as that supply wave recedes, and the economy is still looking relatively strong, we think that demand should kind of absorb all of those units, and we'll see the market start to potentially tighten a little bit again. In actuality, that's not what we've seen. We've seen the market continue to remain fairly soft, even as that supply factor has waned a little bit. And I think part of that has to do with this broader macro uncertainty. We're seeing that play out pretty sharply in the labor market. This chart is showing the number of new jobs that have been created each month going back to 2023. And you may have heard or seen some of these headlines about revisions to some of the jobs numbers. That's what I'm showing here in the light kind of faded part of the bar there. The BLS, the agency that puts together these estimates, they just released a preliminary version of their annual benchmark revision. So This is I want to be clear too, because, I think this is something that's been a lot in the headlines. There's nothing abnormal about this data being revised. It's actually just, it's a very complicated question to ask how many jobs are there in the entirety of the US in any given month, right? The data the data analysis that goes into this is very complicated, and so the BLS kind of releases this data every month, but then they are constantly going back and revising it, and that happens on a month-to-month basis. It also happens with one kind of big annual revision that locks in the very final numbers. That annual revision is kind of what's being shown in that purple segment there. So that is kind of 1 year being revised from March of last year through March of this year. And you can see in this case, that was a downward revision, and it was a pretty sharp downward revision. So that dark purple bar is showing us the job growth that is now our best estimate of where things have been over the past couple of years. And you can see I'm showing this dotted line in here. So 2015 to 2019 monthly average, which just gives kind of a benchmark again of a more stable period. And you can see that since early last year now with these revisions, we've been pretty well under that level. And the past few months in particular have seen pretty weak job growth. So with these revisions, the labor market, is looking I think worse than how we had thought that it was looking, and the more recent months have of data have confirmed that. So there's a lot of there's a lot more risk on the labor market side of the economy. That translates really directly to housing demand. Folks, when they are in a good employment situation, they have a good job and a good income, they're going to be more likely to make an upgrade move, to move out on their own and form their own household. And when the labor market is weaker, that is less so the case, and you see kind of a weaker household formation, which translates to less housing demand. But the other thing I want to talk about here is how kind of I think the labor market translates to housing demand broadly, but how does that break down between for sale housing and rental housing? And another key thing that's been in the headlines here is mortgage rates. There has been actually a decent dip in mortgage rates over the past few weeks, but at the same time, that's been pretty modest compared to what we've seen over the past several years. This has been a real headwind in affordability on the for sale side of the market. I'm just showing the mortgage rate here, but for sale housing prices have risen even faster than rental housing prices. And so when you add up mortgage rates and prices, the monthly mortgage payment on the median priced home in the US has essentially doubled over the course of the past 5 years. And that has been, those challenges on the for sale side of the market have kept people in rentals for longer. That's been a tailwind to rental demand. I don't think this recent dip in mortgage rates is going to really change that in a super meaningful way. If you just look, mortgage rates have dipped, but they are nowhere close to where they were a handful of years ago. And when we talk about that decline from, maybe closer to 7%, where we had been, at the outset of this year, to now maybe 6.1. We're talking about on the median priced home, something on the order of maybe $150 a month in terms of your mortgage payments. And so, that helps folks on the margin. But if you're someone who has been kind of boxed out and felt like you couldn't afford to purchase a home, that probably isn't meaningfully changing the math. And even for the folks who maybe could afford to, but are less confident in the for sale side of the market and are choosing to rent, I don't think that this change in mortgage rates has really changed things in a super meaningful way. And then I've just got this dotted line in here for the long-term average of mortgage rates, because I think, a lot of folks, we had gotten used to, I'm showing a pretty long history here back to 2015. I think a lot of folks had kind of gotten used to what mortgage rates looked like from 2015 to 2019, and then falling even lower in 2021 and 2022. And so people are kind of benchmarking to that and thinking, okay, they'll have to get back there eventually. That isn't necessarily the case. We're actually much closer to kind of that long run trend still. And so I think mortgage rates in for sale pricing still continuing to present a tailwind to rental demand. So the macro picture a little bit mixed there. I think this weaker labor market contributing to weaker housing demand, but rentals are still seeing a bit of a tailwind from a challenging for sale market. And I know we only got about a minute left, so I'm going to stop there. But if folks want to stay on for an extra couple minutes, I can certainly take a question or two.
Thanks, Chris. Yeah, so I think you've nicely painted the picture of a somewhat sluggish rental market coming through this year, heading into historically the slow season. Um, Kind of looking forward into the crystal ball a little bit, what does the early read on 2026 look like when the market does eventually enter that, as you mentioned, historically uh, 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 the busy season, if you will, even though the shape of the seasonal curve is of course shifting.
Yeah, yeah. So, I mean, the crystal ball question is always a little bit tough, but I think, what we would expect, or well, what we know confidently, right, is that on the supply side, this big wave of new supply, it has been receding. It's going to recede further. We are expecting that the number of units being completed is continuing to trend down and will continue to do so into next year. So, in 2025, we've seen the number of units hitting the market come down from where it was in 2024, but still remain actually quite high. Going into next year, I think it's going to come down even further to something more in line with kind of a longer run trend, and we'll have had more time for the unit to absorb all of those markets. So I still think that a return to positive rent growth is probably on the horizon when we get back into the peak season of 2026. But there is, now some risk from this murkier macro outlook. If there does end up being a recession on the horizon, for example, that could complicate the picture. But if the labor market remains relatively healthy, then I think we'll expect a return to positive rent growth and some tightening in the occupancy rate.
Great. Thank you for the insight there. So we are at time. It's 10:31. Want to thank everybody for joining us today. Just to sign off, as Chris has up on the screen, there's some links that you can use to reach us if you have any questions. Research@apartmentlist.com is kind of the easiest way to get in touch if there's anything you're interested in. We will be distributing a recap of this presentation along with a quick survey to make sure that what we're offering here is helpful for you. So we thank you in advance for providing some feedback. Otherwise, thanks again for everyone for joining us, and we'll be back in a couple months with the next one. Take care.
Thanks, everyone.